was like, we need to have the voice of where the capital is actually coming from, and like, why is it even investing in this sector? My guest today is Vincent Van Bijleveld. He's the director of the Global Real Estate Engagement Network, GREEN, and managing director of Finance Ideas. He leads a powerful coalition representing over 2 trillion in assets under management and advises about 30% of the top Dutch pension funds on how to allocate their capital to force real-world change in real estate. My conversation with Vincent today covers everything from capital allocation into real estate and what criteria comes with that in relation to sustainability. We cover off regulation, whether that's a positive or a negative driver, some of the benchmarks and tools and metrics that investors are using. And stick around until the end, where you'll hear what problems Vincent believes need solving in 2026. Vincent, thank you so much for being here on The Future We Build.
Thanks for having me, Alex.
This is my first one.
Yeah, really?
Yeah.
Okay,
You're
cool.
the first guest.
Cool. Well, I'm honored.
I'm so glad that we
I'm
managed to make this work.
Guinea pig in English, isn't it? Yeah.
That's a good expression. Yeah,
I
you are the
think
guinea pig.
What is it in Dutch? It's actually a trial rabbit.
Is that right?
Probably sounds even worse.
Is that the actual
Yeah,
trial rabbit?
Yeah.
Okay. Guinea pig, trial rabbit. Yeah, okay.
It's probably kind of, from a pharmaceutical industry. It's not very ESG friendly.
That's the origin.
I'm not sure. That's what I would guess.
Yeah, true, actually. And that's probably where guinea pig came from, I guess.
Yeah.
Maybe. Anyway, maybe to start with, if you could just sort of introduce yourself and a little bit about GREEN and Finance Ideas.
Sure. Well, first of all, thanks for having me in your first podcast. Vincent Van Bijleveld is my name. I work for Finance Ideas and the Global Real Estate Engagement Network. The Global Real Estate Engagement Network, in short GREEN, is a collaboration of investors in real estate. We started life as a collaboration focused on engagement, so indirect investors in real estate, engaging with companies that manage assets, real estate. And over the time, we've also included a systemic work stream that works to solve the more systemic issues that a single company can't solve on its own. For example, the ensuring that we focus more on the specific measures that are relevant for green premiums, brown discounts, etc., etc. Members are global. They're asset owners. They are asset managers, indirect, and they are managers direct that actually buy buildings.
So let's start there. Tell me, why did you start GREEN?
Yeah, I think there's a personal motive and a goal of GREEN. From a personal perspective, of course, I'd like to contribute to kind of reaching net zero as a world. I think our generation needs to kind of ensure that the future generation lives in a livable world. But GREEN as an organization looks at managing financial risks in real estate related to climate change.
The sort of starting point from this, like I say, was where is the capital coming from when we talk about real estate? And I have to say, so many conversations I have, certainly when you go down the supply chain, the value chain of people who are actually responsible for managing the buildings or providing solutions for buildings, they actually often don't know what the value is and the value chain is, and where and who ultimately is the ultimate kind of beneficiary of why this is even an asset class. And so, like I was saying, when I was thinking about this, I've got heads of sustainability, I've got advisors, I've got tech people, but I was like, we need to have someone who can kind of speak to why they even invest in this asset class. For listeners, when I was at LaSalle, we obviously were engaged with you through some of our funds as well. And I think, clearly you guys were a voice that was sort of pushing, certainly our sense was of all the clients that we had and all the investors we had, well, here's a group of investors that not only are pushing probably further and faster than anyone else, but you've actually kind of all pulled together and, rather than every individual client and every individual investor having its own perspective, here's a group that's sort of coordinated, which is helpful, I suppose, as an investment manager, because you're like, okay, well, we will understand what they expect. And so I guess, in that regard, what, both in terms of kind of what was, but also what is and what will be, million-dollar question, billion-dollar question. Do you think the real estate sector, and through the lens by which I guess you see it through the investments you're made or the members of GREEN, is it moving fast enough? Is it are there signs that it's moving fast enough? Are you happy with that? You know, and if you've got sort of relative comparison to other asset classes, like, you know, where do we sit, and kind of how do you lens that as an investor? And obviously this is in the context of predominantly, I guess, climate, but also other, you know, sustainability issues as well.
Yeah. I think it's a really difficult question to answer because there's different answers and different points of view there. So I think within real estate, it is a relatively easy sector to transform because at the end of the day, we don't have to change our kind of core business. You know, we still own assets and we find tenants. I mean, if you're in the oil and gas industry, you have to change your whole kind of business. Yeah. If you are in the cement industry, you really have. I mean, it's still cement, but you really still have to make huge changes to your operational processes, make huge capital investments.
The infrastructure needs to
infrastructure. I mean, if you look at, let's say, the pure energy, I think things are moving faster in wind and solar because it is financially viable to do so. Yeah. In the automobile sector, you know, there's also a clear tendency to move faster there. I think our sector is not a very concentrated sector, so there's like a zillion real estate managers, which in itself probably makes it a little bit, you know, slower to transform because, well, there's some you know, early movers that are, you know, really ahead of the curve and really making lots of progress, but there's also, you know, significant parts of the industry and even outside in institutional investors. I mean, you know,
well, the majority of assets are outside of it, right?
Yeah. So in that sense, it's hard to really give an answer on that. I mean, as a whole, you know, if you look at International Energy Agency reports, I mean, lagging in many of the sectors, including real estate. So you can't be kind of too happy with, let's say, where we are going as a whole, let's say, global economy.
And I guess, you know, to that point, as you mentioned, like, it's an asset which, you know, you can refurbish, you can move, you know, you can reshape, you can transform, and it's still the kind of same bones, which is, you know, attractive in some ways, but it kind of, that lends itself perhaps to what's been happening, which is sort of incremental improvements, you know, bit by bit, which, you know, stand back over 30 years, maybe that's great. Whereas, you know, perhaps in other industries like you're alluding to, there's been transformational change, like it's a new energy source or it's a whole new infrastructure. And I'm just, you know, from your lens, or, you know, is there an appetite? And you mentioned some of the leaders. Are you interested, or are there things happening that is interesting from institutional capital that is completely new, a completely new way of doing it?
In other sectors, you mean, or?
Well, both, but obviously specifically to real estate. You know, I'm just curious to know, are you seeing any kind of genuine transformational business models?
Well, for sure.
Okay.
I mean, but even there, you know, transferring older assets to newer assets / you know, non-energy efficient towards, and it's also in a way a traditional way of doing business.
I would argue that's not very transformational.
But it is transformational in the sense that, you know, there's of course for such organizations that are more kind of value add opportunistic, you know, they are, you know, not only trying to kind of attract new tenants for, let's say, you know, the shiny new facade, but also because that shiny new facade is more energy efficient, and especially in the office sector. You know, there is a demand from tenants for, let's say, low embodied, low operational energy.
So where do you stand on this then? Because this is something I've grappled with, and obviously I've been in, you know, the institutional, you know, market, as it were, in that, you know, you've got all the institutional funds, you know, managing the money on behalf of, you know, your clients and your members. And, you know, we've seen obviously a huge amount of movement towards, as you say, that sort of prime asset, moving away from brown or discounted, or however you wish to define it, and looking at moving into, you know, prime and using sustainability as part of that. And, you know, part of my job was, you know, helping to find ways as part of the acquisition process, like let's screen the asset, let's make sure that we know what we're going to be buying. That does, and then obviously let's sell the brown ones, let's sell, you know, the obsolete buildings. Well, that's fine within the universe of that institutional capital. Mm-hmm. The problem is that you're selling the building, or you're giving away the building to someone else.
Yeah.
So the planet as a whole, to sort of use that, you know, the planet as a stakeholder, they don't really care who owns the building. It's still there, it's still being run. And arguably, if it's not being institutional capital, if it's not being run by institutional capital anymore, it's being now run by, you know, private landlord or something else, they're not going to have the means and to, you know, to transform perhaps, you know, that asset. So there's a bit of a sort of moral conundrum, really, of like, you're moving kind of institutional capital from brown to green and transitioning that, and that all looks great. But what you're leaving behind and for other people to deal with is more difficult to sort of, you know, I don't really know how to square that away. It's a difficult one.
So I think there's 2 points to that. So first of all, I mean, the financial sector isn't, let's say, morality the biggest aspect. So I think we just have to live with that. So you know, of course, it would be great if we can change, let's say, the whole world, but you know, I don't think that's realistic. So it's a matter of fact that, you know, we are asset owners hire asset managers to get returns. So
play within your own
but
field,
I also don't think it's really a big problem, because at the end of the day, we need a bigger green premium / brown discount. So whenever institutional investors are selling, let's say, their lower quality assets, you know, at some point in time, that brown discount will become bigger. I mean, when we engage, we sometimes engage with companies that are not already integrating, especially in Europe. I mean, there's of course, you know, the whole brown discount, green premium differs per geography, etc., etc. But especially in Europe, when we talk to an asset manager that doesn't kind of integrate carbon and energy in the investment decision-making process, we are really worried, because we're saying, well, you know, you will probably buy the kind of the pure performing assets. And as an investor, that's not what I want. So, you know, we are pushing them purely for financial reasons. You know, at least that will resonate more with them in general than you know, why don't you save the world? So they will start, you know, looking at those aspects as well, which at the end of the day will decrease the value of those assets, which will make it easier for those kind of value-add opportunistic strategies to buy and retrofit. So, I mean, this is an argument from a residential manager. What the residential manager would say, well, at the end of the day, a private owner of a house doesn't really care about the financial viability of an investment. So if you look at many sustainability, I mean, many sustainability investments will make return, but you know, they might not make the 10%, 8% required for a fund manager. If, let's say, you know, transforming to a heat pump, you know, delivers at 2% return, but also, you know, increases, you know, all other kind of, you know, it's a better place, etc. I mean, as an individual, you might think, well, you know, someday I have to change anyway. Let's do it right now. So it's a little bit less kind of focus on. So, you know, and again, it's of course, it's an argument that's you know, that favorable for them. But I also believe that at the end of the day, especially, you know, what is already institutional owned, I don't think that will be kind of sold off to somebody who can't afford any of those kind of transformations.
Yeah, it's interesting. I mean, you know, that is the game that's being played at the moment, right? Is the institutional players are really kind of trying to get sophisticated, and this is where data comes in, but trying to get really sophisticated on particularly the acquisition point of digging deep into the technical due diligence of a building to really understand, is this a building that, you know, we can sort of underwrite the capex to ensure that we can deliver that. Whether it's, you know, GRESB, or whether it's, you know, a rating system, or whether it's, you know, SFDR allocations, whatever that's driving that sort of dial. And there's that sort of arbitrage at the moment of, well, there's a market opportunity to, you know, sell the asset.
Yeah, and at the end of the day, I mean, it's still real estate, location. So most of the managers would say, well, you know, yes, it plays a role in my valuation, but does it play a huge role in whether I'm going to hold or sell that building? Not necessarily. So of course, if you have two assets, you know, next to each other, you know, I'm going to favor the one with lower capex, which is a good thing, because it, you know, it increases brown and green premium. But if it's a prime location, it's still a prime location. I still want to have that asset, whether it's efficient or not.
Yeah, of course. And I mean, you touched on it there. I was going to be curious, because, you know, the focus, let's be honest, over the last, you know, 4, 5, 7 years even, has been decarbonization. You know, carbon energy has been the main topic. I mean, when I was at LaSalle, I'd say 80% of the effort of the team, the structure of the team, the expertise we brought in, and the focus was 70-80% focused on decarbonization. From your lens and the lens of your clients, when they're thinking about kind of long-term risk and resilience and the definition, I suppose, of sustainability, is that the number one? Is that still the number one? Do you see that changing? Are there any other metrics or KPIs or you know, areas of focus that you and your clients will be looking at?
I don't think I'm going to surprise you if I tell that physical risks, adaptation becomes much higher on the agenda, for several reasons. So, you know, first of all, we're seeing those risks now and then. Well, maybe a few years ago we were like, you know, it's like 2070, 2080 when those risks are actually hitting us. I mean, insurance costs are going up, especially in the United States. So there's a a reason from a financial perspective that adaptation becomes more important. And by the way, also, if we're not meeting those Paris goals, the risks of physical risk are going to become bigger and bigger over time. Then there's of course the situation in the United States when we are engaging with United States REITs. I mean, the transition risk has become smaller, at least on the short term. Because during the current administration, we don't expect a lot of energy efficiency measures to be taken, even on the state level. Where the states might lean towards more progressive policies, but don't necessarily want to implement those policies right now, given all the...
Well, they might not call them energy policies, or they might not call them sustainable. But it's interesting because obviously, cost of living, energy price, crisis, and same in the US, right? There's a real drive to cut costs, and energy, clearly is a key driver of that. So, calling it.
So the measures are still taking place.
They're still there. Yeah.
So I would say, and that is a big difference between, let's say, the US and especially continental Europe. UK a little bit in the middle, I would say. This again, single materiality versus double materiality. I think many, both on the asset owner side, but also on the manager side, there is more willingness to, and also more conviction that at the end of the day it will become financial material. Obviously, if there's legislation coming into place, then it is financial material already, whether you like it or not. So I think in Europe, investments are being made that are not necessarily per today kind of the 8% return, but they're just like making a portfolio more resilient, and to a certain extent also simply being a good citizen as an organization. I think in the US, it's kind of almost always yes, we want to kind of reach net zero. However, of course within a boundary of a sustainable financial return / optimal. So we're seeing less activity in general in terms of retrofits in the States than in, let's say, than in Europe or in Asia.
I guess the question would be, if an investment manager or asset manager comes to you and says, look, we've modeled our entire portfolio, we've modeled the capex to get us to, whether it's Paris 2 degrees, whatever the metric is that you want to align with, it's going to cost us X. That's going to drag on performance in the short term, but it's going to get us by 2030, 2040, whatever.
And it depends. I mean, it really depends also per sector. In the office space, London, Paris, Amsterdam. I mean, there is this green premium in rent. So you can't even so you need even to be at that level. So it's not always a drag on return, I would 100%. Say.
But if, I guess, over a portfolio of a whole, let's say with mixed portfolio with different asset classes, if that, I guess the scenario being, if there is projected drag on performance, would you say that your clients or a selection of your clients, are there any clients out there that would be willing to say, okay, we're willing to take a short-term hit, but make sure that the portfolio is positioned in a resilient way by 2030, 2035, whatever it is, that's their view? Or is it still very much, no, look, you have to achieve, within the fiduciary responsibility of the short-term, margins, but we also expect you to be delivering? Because in the practical reality of what that means, and having been in that seat, it's, well, that means we can only do these retrofits now, and we'll have to put off the next retrofits until the next time in the hope that technology gets cheaper, policies are there, whatever it is. And so I'm just curious to know, like, whether or not from your lens and the clients that you work with, is that conversation happening? Is there an acceptance or a tolerance there?
So I have to come back to the discussion on, who is the asset owner. So if the asset owner is somebody who is kind of responsible for the returns of a portfolio, not really. So I mean, there's the focus is, so there might be a goal from a board that we want to be more sustainable.
It doesn't translate through.
But it translates through till the level that it is financially acceptable. I think if you go to the pension fund board level, and as I said before, my main experience there is in the Dutch market, because within green we mostly work with the asset owner being the real estate department of which are the kind of the investors. But in the Dutch market, that's a kind of part of my work as well. We work with, let's say, making in all asset classes, by the way, in making responsible investment policies, and there we see that many pension fund board members, and even more so, by the way, the participants behind those pension funds, because the pension funds actually ask their members, like, what should we do? What is it what you want to do in terms of risk return, impact / sustainability? So on the board level, I think there's a willingness to kind of accept without
without writing
formally
it down.
saying it
Yeah.
exactly. So I'm,
Yeah.
I'm on
Yeah.
shaky ground now.
Yeah.
But like, if
Don't
it's
worry,
like 10,
we're-
if it, well, no, this should be okay. If it's like 10 basis points,
Yeah. Okay.
do you really notice that at the end of the day
Yeah.
in the pension results?
Yeah.
Given also the fact that the members are willing to kind of, spend or invest in.
Yeah.
And I think also there that at the end of the day, an investment belief and
Well,
there, it's not the truth.
Yeah.
So if you're strongly convinced
Yeah.
that legislation will come there anyway,
Yeah.
and it is indeed investing in resilience,
Yeah.
then that 10 basis points that you might forgo in terms
Yeah.
of,
Yeah.
net return this specific year will come to you
Yeah.
on the longer run. And from a, let's say, purely technical view, a heat pump is much more efficient than gas boilers.
Yeah.
So it should be more, it should lead to better returns, which is of course a great tailwind for those changes.
Yeah.
Current pricing between energy and,
Yeah.
and gas is not necessarily always helpful, and also legislation, taxation, etc.
Yeah. No, it's interesting. What you're, it's the acid test, right? Is if you're setting a policy or an objective as a business, and you're saying, look, we stand by that. This is this is a risk to our business over the long term, but then you don't factor that into the way that you allocate and judge your investment. Those two things aren't, they're not compatible. So.
And what I have seen changing, I think, from, the sustainability people might have in the past be very much like, okay, net zero, that's what we want to achieve. Yeah. I think, reality kicks in that kind of, in that part of the industry as well, like, okay, we can push for something, but if it's not financially viable, we won't get there. Yeah. This is actually one of the reasons why within Green we have started a systemic work stream where we not only engage with the companies, so it's of course relatively easy as an asset owner to tell you as a manager in your previous capacity, like you need to do net zero and by the way also still make great returns. But there are hurdles. If that green premium brown discount isn't big enough, then you can't do that. So within our systemic work stream, we're now working both with the indirect investors, so shareholders, if you will, and the real estate companies themselves to tackle some of those hurdles. One of them being that in many of the kind of rating systems, like BREEAM, LEED, or GRESB on the portfolio level, those are holistic ratings. And tenants and investors tend to be not always too sophisticated in terms of sustainability. So they think, well, if there's a great GRESB score or a great BREEAM score, this is a net zero building, which is definitely not the case. So we are working with the industry to ensure that we are measuring the right metrics. If you're looking at that, all those other metrics are relevant as well. But if you're looking at climate, then you should look at a subset of those metrics. Those should be clear to the markets, which should at the end of the day lead in that kind of brown discount, green premium difference being bigger, and therefore better pricing in the markets.
I was going to ask you about GRESB. Because it's from within the industry, the real estate investment manager.
You're not going to make it any easier for me today.
Well, I'm just curious because from our perspective, the collective, I guess, of within the investment manager and REITs, obviously, having to complete that. It's such a big exercise every year, and the listeners out there that have been involved in it will know exactly. It's a huge amount of effort. But on the flip side, when I sit down with our portfolio managers or fund managers at the beginning of the year, they'll be like, what's the need do you have? From the hit 5 stars. It's it's the only way we're going to go and raise capital. And I guess that so it's proving I suppose its own worth in the fact that you're putting all this effort in, but it is actually material. And I guess from so there from your lens, is it because there's an absence of anything else? Like how valuable is that as a tool? Is it now become too big and too kind of ubiquitous that it's, do you know what, this is now the barometer of
So I'll start with some positive notes, then some criticism, and I'll hopefully also
it's
end
gone through
with
a
some
big
positive
change.
notes.
I understand the last
for sure. That's
year,
probably the last part as well. So obviously, GRESB has been kind of the reason why our industry has kind of started to focus on sustainability. So I think that compliment to the GRESB organization should always eternally be acknowledged. Without GRESB, there wouldn't be any data, which is also per today still very relevant. There wouldn't be any attention. So I think that's kind of lots of compliment with that. So then, the way GRESB works, I think any rating works. That at the end of the day, sustainability people think that everything is important. So this is important, that is important, and they don't necessarily care about financial materiality because they are kind of prime topic is, the better world. So I think, and I know that even internally within GRESB, they talked about, let's say, the beast. It has grown and grown over time in terms of metrics.
Yeah.
And I think the honest answer is that sustainability people might look at all those, well, even that is probably not true, but they might look at all those data points. But then the actual investment decision-making process, not happening. So either they're looking at the overall score, like the 5 stars, which is mostly for the less sophisticated investors. I mean, even the Dutch central bank, when they kind of prepared a draft proposal on how you should manage climate risk, they said, well, a good example is this pension fund is only investing in GRESB 5-star funds, which, I mean, as an expert, you and I know, doesn't say a lot about how climate resilient that portfolio is, either on adaptation or on transition. So, and then the more sophisticated investors, they dive into kind of the more specific data points, mostly on the climate side, carbon, energy, et cetera. And it's of course really hard to change this system. So to be honest, I think they have been late in accepting that the current methodology doesn't work anymore. It doesn't differentiate the true leaders, from, let's say, so and then in the positive note is they are now going through kind of tremendous changes. They have been relatively slow as an organization. I'm not sure whether if I would have, if I would have been the leader of the organization, it would have gone any faster because it is hard to change an existing organization, an existing system.
I mean, I think you're right, and as I say, they've obviously done. I was just looking in the news recently. There's some changes coming out, big changes coming out. So let's see. I think that now coupled with SFDR, certainly from the unlisted side, SFDR, I think in terms of a needle mover, that was another one that in the last couple of years has really kind of shifted the non-sustainability professionals, if you like. So that, again, having been on the inside of the fund teams, the investment relations teams, everyone was like, oh, we need to be Article 8. We need to, should we be Article 9? Should we be Article 8? So I think that again, looking back, really positive in terms of a marker. Did they get it right first time? No. Are they adapting it? Yes. Looks like the new version coming out will address some of those key challenges around, like, where does my portfolio actually sit, and is it transition? So hopefully it will become a clearer marker to the investors. But I think those two, well, certainly the SFDR, to me, it's like if you could get, regulation's often thought about is a dirty word, or it's they're not fast enough. But actually, if you get it right, it can actually be a real kind of mover, and it can really kind of to your market is it can direct capital flows, right?
No, for sure. And I mean, also here we see the difference per geography. It won't happen in the States, so you need other kind of incentives. Although again, Local Law 97 is probably one of the most stringent regulations in the world, and Local Law 97 has, in Boston and other regions, kind of similar arrangements. But of course, the legislation does push the industry.
No, I thought for me that was a real kind of moment when because it happened whilst I was in post at LaSalle, and it was suddenly the conversation with people in the business around like.
But I think European Performance of the Building Directive is probably the more relevant legislation. I mean, SFDR.
Top down, I think SFDR
is. I would say that, let's say, SFDR up till now for real estate fund specific, given the fact that the actual impact in real estate is much more in the transformational side than owning great buildings. I think thus far, and maybe it's because I am the more kind of sophisticated investor in that space. I mean, whether it was a 6 or an 8 or a 9, it didn't really say anything to me.
Yeah, that's a good point. Well, most of them are an 8, right? It's like, is that helpful?
And the 9s weren't really 9 because they simply had really new portfolios maybe.
Well, let's hope that the new version addresses some of that, and it does start to allocate. But I guess maybe rethinking it is, you're absolutely right, is that the first version, it wasn't that helpful in distinguishing laggards and leaders. No. But what it was good is it gave I guess a lens through which, and a conversation and a language, that's probably the best word, a language between the investor and the investment manager around, okay, well, what are you aiming for, and is this actually how you're going to define your fund or define your portfolio, and that was the conversation that we would then have with our portfolio team. So that was a positive, but I think you're right, the way that they designed it.
And I think we or do we overestimate it? But I mean, the level of knowledge of, let's say, because at the end of the day, a financial investor doesn't really care about any of those labels. So it should be the board and the kind of the people that are member of a pension fund or client of an insurance company or whatever, that should steer their money.
Sure.
And I think we should not overestimate the knowledge that board members and even more, of course, individuals have in terms of, is it sustainable or is it not?
Yeah.
So it is really, really complicated, I think, to kind of get it right in terms of that demand signal. Yeah. So I think, therefore, I said that the building directive is probably more effective, even as it simply has to comply with certain energy or carbon performance standards. Then it'll happen. It'll become financially material, and even the ones that don't care at all about sustainability will have to make that change.
I guess it's I sort of think about this EPBD, the European directive, is almost like it's sort of bottom up, right? It's tangible things that you have to deliver within the built environment. SFDR, or it's okay. Well, if we can align those two things, here are the metrics that we want to use, or here are the things, the goalposts that you have to hit, and the money coming in is going to be directed to the things that are better versus the things that are not. Actually, those two things working together should work.
I am not too positive about, let's say, the how we can steer the world with capital. I think in truly impact spaces, yes.
Right.
But I think at the end of the day, real estate is such a big sector, and so important any portfolio that, and I don't think that, let's say, a majority of the investors in the world will start to kind of warm glow. Let's try to make impact. So I think the impact side or the change side should become financial material in order to truly scale, and it helps. I mean, any drop counts. So of course, if SFDR helps, to kind of steer, but I don't expect lots of investors to really make that change if return-wise, there would become a difference.
So if I'm an investment manager in 2026, 2027, and I want to raise capital from, your members, what other than the sort of the normal, what would you expect? What are you expecting? What are you looking for? Is there anything new, different that they should be doing? What's table stakes?
I think you can't really say our members because that membership base is pretty broad.
Okay.
And of course, members are both pension funds and indirect managers, and with the new work stream also the direct ones. So you can't really say about, let's say, the whole population at all. What I'm seeing, and again, this is a little bit of a sidestep from green, within the organization that I work for that runs green, but also other initiatives. We're now doing research on sustainable investment in general. And there we see that, let's say, a portion of the asset owners are, willing to kind of dedicate money towards kind of more impactful and really make changes in their strategic asset allocation for kind of, reaching the goal, which could be financially driven. I'm a strong believer in the fact of universal ownership. At the end of the day, we all have a financial benefit in preventing climate change to become bigger, because at the end of the day, it'll cost us money. So there's a group of pension funds that is willing to kind of commit capital to more impactful.
So
kind of Article 9 where it starts at that truly and then you could discuss whether Article 9, 8, 7
but true
and,
kind of impact
and then and then there's also a very significant part, and I think on a global or more European even level, the majority of the investors there, I think in the Netherlands is a little bit more impact oriented, double materiality than the others. It's my general
you guys are ahead.
Not really sure why. But anyway, but there's a big group that is willing to kind of let's say if you want to go into infrastructure, and within infrastructure, renewable energy is kind of similar risk return than the rest of the sectors. Then why not allocate to renewable energy? And at the end of the day, you probably need both groups, because you need part of the capital, is willing to make that, a little bit more effort, a little bit more risk maybe, or a little bit more governance budgets, compared to, let's say, simply investing in, I don't know, a broad stock-based passive index.
No, it's interesting because hearing you, one of the things sort of I've been thinking, and actually both in my previous role, but also since, is this concept of like impact funds. What does that mean for real estate? Traditionally, or typically, that's mainly kind of social impact indicators that are used, and actually environmental impacts. It's more difficult, and I think obviously decarbonization is now becoming almost. So I think it'd be interesting to see, as you say, if the capital starts to allocate more towards, well, we want to see non-financial KPIs associated with our our investment. What does that look like, and how robust? And that comes back to data, and how does this actually get verified? So, yeah, that's okay. That's interesting. I mean, a question I have, which I'm going to ask all my guests, is like, right, 2026. Let's say, is there a challenge or a problem that you're trying to solve right now, or you will be trying to solve this year, that you're looking for a kind of solution for, or you'd like to see solved?
That I like to be solved within our organization, that we will solve, or
yeah.
the world will solve.
You, but I'm just, is there something that's like, oh, this problem doesn't go away, or I can see this is a challenge that we need to confront? Sorry to put
I
you on
think
the spot.
a big and then it maybe comes back to SFDR kind of topics as well. So the devil is in the detail, and to really understand whether something is either impactful or green or whatever, you really need to understand the details.
Yeah.
And naturally, we people are kind of lazy. Yeah. I mean, if not necessary, then we tend not to dive deep, or dive deep in only the things that we care about. Yeah. So investors in real estate, there are very few investors that have dedicated teams and that truly understand, which metrics are relevant in terms of risk, return, impact, etc., etc. So from let's say the outside, my outside wish is that let's say board members start to focus more on real estate. As a sector, it's responsible for 30 to 40% of global emissions. Yeah. So without transforming real estate, we'll never get anywhere near to net zero, whether it's 2050, 2060, 2070, or 2080. Yeah. We need to transform real estate. Yeah. But in asset owner portfolios, it might be maybe 5 to 10%, so it's already a lot smaller. And then the sector is very fragmented. So where in oil and gas you have Shell and Total and Exxon, really large players where people tend to focus on, looking at my portfolio, these are the big emitters, I have to focus on those companies.
There's not many
within the real estate, there's like the listed space, 200 players, maybe non-listed, there's more dedicated allocations from pension funds. So I think my wish would be that pension boards, take more, are looking more at real estate and understand the importance of that sector.
That's interesting, yeah. Okay. I mean, again, sort of sat on the other side of it when we would engage with pension funds or any client, but certainly pension funds. I think the journey I went on was, it is improving. I think their knowledge, they're equipping themselves.
But you weren't talking with board members, I think.
No, probably not board members. No, yeah.
So
fair point.
It really starts, at the top of the pyramid.
Understood. Yeah.
So if my bonus as a manager in a pension fund, I'm the real estate manager of a pension fund XYZ. Yeah. And of course, if I would be that manager, I would also spend 90% of my time on other topics in sustainability. Of course, So it's only fair. Yeah. I mean, if the incentive is on making a great return, those teams are generally smaller than the equity teams or the stewardship teams don't really.
Well, that was my point. Is that actually there was very few, if any, real estate experts. They didn't actually weren't knowledgeable about the sector, and they were sort of transposing their policies or objectives from other asset classes, and we would get RFIs or RFPs, and it was like, it's not really, the amount of times we'd have to be like, that's not really relevant to our asset class, and we'd have to kind of figure out a way of translating it. So, I mean, you've kind of asked my second question, which I ask everyone, is if there's one thing you could ask from government, business, or individuals, what would it be? I mean, you've kind of answered the business one, is if you're a pension fund board member, focus on real estate. Yeah. But I'm curious, in terms of government, maybe legislation, regulation, or indeed individuals, is there something that you would wish for if you could say, do that one thing and everybody would do it?
I mean, the answer would be kind of too obvious. So I'm trying to think of a more kind of, new kind of answer. I mean, at the end of the day, we are the government. I mean, we vote.
Sometimes we forget that, and they make us forget that. But yes.
So, and I don't really know. Obviously, net zero is an important thing, both from a kind of financial materiality, in terms of, if I live in Amsterdam, in the Netherlands. I mean, I live kind of at sea level. Personally, I live in a floating house, so I mean, I can simply move my house to Germany, but and I will be a refugee, which is probably difficult entering Germany. Anyway, so yeah, those are those are the obvious answers. So I'm thinking about what is. It is probably we probably need kind of more shift. And to be honest, if I look back when I started my career in sustainable investing like 7 years ago, so I am, of course, being in this industry, always a bit disappointed. Well, we're not going fast enough, and that's always the case.
20 years.
If you look at change, the 1 year change is always too small.
Yeah.
You're always disappointing. You want to go faster. If you look back, like 10 or in your case even 20 years, I mean, change has been tremendous.
Yeah.
So. Am I positive that we're going to reach net zero by 2050? No.
Yeah.
But I mean, I don't see any other route than towards net zero at some point in time. Yeah. And it's really sad that we will not be able to make it most likely by 2050. Yeah. But we are making significant progress. Energy is becoming cheaper. If electricity is becoming cheaper, then even more cheaper compared to gas, then the heat pump will become, much more.
Well, the drivers become more, right?
The drivers are there. So we will get there someday, and it's probably financially viable to do it sooner and invest in making the change, because then you're ahead of the curve.
Yeah, and I fully agree with that. I mean, I remember reading a quote somewhere, and it was, we're probably going to miss 1.5. Well, the next one's 2.
No, the next one is 1.55.
Exactly.
5.1 or whatever.
It's like, no, it's not. So we can still aim for that, and but I think, as you say, the drivers are becoming, more tangible, right, for everybody. Everybody's feeling it. The cost of things is just going up. So if you can find ways to give people cheaper energy, cheaper way of living, then they're going to do it. So thank you. Really appreciate it. Really interesting to get your insights.
Thanks for inviting me.
Yeah, no, absolutely, and thank you very much for your time. That's it for this week's episode of The Future We Build. I want to thank you so much for listening to us wherever you are. If you're navigating these same challenges, from pricing in climate risk, decarbonizing buildings, or if you're scaling a new product or solution, join us on LinkedIn. Search for me, Alex Eds, or follow our official page at The Future We Build. That's where we break down these episodes further, discuss the topics and discussions, and connect you to the leaders engaged in this mission. This show and the guests I invite will be influenced by the conversations we have on LinkedIn. So if you have ideas or would like to hear the thoughts of an industry leader, let me know, and I look forward to continuing the conversation with you there. You can find the show notes and full transcripts on our website. And if you found today's session valuable, please hit subscribe on Apple, Spotify, or wherever you find your podcasts. Thank you for listening. I'm Alex Eds, and I'll see you next time.